And good afternoon, everyone. John Hutchinson with the Millionaire Blueprint. I'd like to thank you for taking time out of your day to join us here this afternoon. I know everybody's dying to get off to those early games in the NCAA tournament, as am I. So I'm going to try to get you in and out of here in about 45 minutes. And we'll be able to wrap up as quickly as possible. I have a really phenomenal presentation for you. I'm always excited to deliver this one. We've been helping investors around the world for the last 3 years with this program and with the concepts that I'm going to be teaching you today. I want to start out with a couple of things. First and foremost, this is a live presentation. This is not a recording. So we are live, and I will be answering questions as I wrap up at the back end of the presentation. So feel free to load them up into the question box, and I will circle back and answer as many questions as you folks have. Before we get started, I always like to do a quick audio video check, make sure that you can see the screen. You should see the title slide in our presentation and also hear my voice okay. This is a program that taps into Google Hangouts. So from time to time, there may be technical difficulties. If you do experience a loss of audio or for any reason, if the screen freezes on you, the best thing to do is simply log out and log right back in. But if you would, just take a moment to type a yes or a Y in the chat box to the right of your screen and let me know that you can hear the audio okay. Then I will know that we can get started. And feel free to let me know where you're from. I always like to know how far around the globe our presentations are reaching and where you may be located. So we're not tracking that or anything. This isn't the NSA. Ha ha ha. So, just a city, state, something like that, or country. We've had pretty good presentations where we've reached as far as Australia, Malaysia, China, shockingly China, and the UK, France, Italy, all kinds of wonderful countries. So looks like we've got a nice little crowd on hand today. So glad to have you folks along. And looks like the audio is okay. So I'm going to get started. And Isaac from New York, thank you, sir. Welcome. And we've No Name from Boston. Welcome, Boston. I hope you guys have dug out from the massive snowfall there this year. Chris from South Carolina. Welcome, Christopher. And so we're good. All right, and I'm going to fire away and get started. We're going to do the legal disclaimer. This is to make the lawyers happy. U.S. government required disclaimer: Forex, futures, stock, and options trading is not appropriate for everyone. There is a substantial risk of loss associated with trading these markets. Losses can and will occur. No system or methodology has ever been developed that can guarantee profits or ensure freedom from losses. No representation or implication is being made that using the Millionaire Blueprint methodology, system, or the information in this presentation will generate profits or ensure freedom from said losses. So if you enjoy watching paint dry, grass grow, or water boil, you're welcome to read our full disclosure and disclaimer on tradersreserve.com or millionaire-blueprint.com. So now that we've told you you can't make money, let's tell you how you can. We'll start right at the top with the simple premise. As we said in our email, our goal is to turn 250 investors into millionaires. And by the end of this webinar, your goal is to be one of them. And when we're finished, you will have in its entirety the only step-by-step investing plan designed to create millionaires. It includes a unique investing plan that accelerates the growth of your money so that you can reach our $1 million goal in less time than it takes most people to pay off a car loan. It includes specific yet easy to follow rules so that you automatically secure investing gains and prevent portfolio wrecking losses. And it includes the one number you need to know so that you're always buying the right stocks and avoiding the wrong stocks. When you put these three components together, you will have a powerful yet safe strategy that grows your portfolio by compounding your returns every single month. That's monthly, not annually. But I do want to be clear that this strategy, this plan, is not about high-risk investing, penny stocks, day trading, a get-rich-quick scheme, Forex trading, or real estate speculation. We are and will be focused on investing in stocks and in the stock market, but probably not in a way that you might think. And I know many are concerned, and frankly, rightly so, that stocks have gone up so far, so fast since the 2008-2009 financial crisis that you're probably worried that we're in another bubble, or you're worried about buying the top only to be forced to sell the bottom yet again. And I'll be honest, I have many of the same concerns, but that's why what you're about to learn is incredibly powerful for you, because if you can follow some simple rules, you'll discover that it doesn't matter whether the market is rising or falling, you'll have a strategy to profit in any market condition. You'll never need to worry about buying the top of the market because our one number strategy ensures that you're buying the right stocks, not the whole stock market. And that provides you with continued and ongoing profit opportunities. You'll also learn that by using our unique investing plan, your portfolio is actually protected. It's automatically shielded against bear markets, against big losses. You'll see why and how in this video. But you may be curious at least about why we've chosen $1 million as the goal, and why not 10 or 2 or 200. Well, first, a recent Fidelity investor survey discovered that baby boomers alone face a $24,000 annual income gap in retirement. That's post-financial crisis of 2008, 2009. Generation X, sort of our next big retirement group, they face a $20,000 annual income gap. So to put that into context, think about living the life you live right now on $24,000 fewer dollars per year. For most people, that would put you below the poverty line. And a second survey found that 65% of Americans have $50,000 or less saved for retirement. So it's a critical issue for many of us as investors, as working folks. We don't have enough money, and by the time we get to retirement, we won't have enough money to enjoy retirement. So this leads into what we call the retirement gap. And quite simply, the gap is the difference between the amount of money you have saved for retirement today and the amount of money that you'll need just to enjoy a secure retirement. And let me clarify that and qualify that by saying when I'm talking about a secure retirement, I'm not talking about pie in the sky retirement. I'm not talking about owning a vineyard in France, some private island in the Bahamas, or your own fleet of yachts and private jets. I'm just talking about having enough money to enjoy your later years. When you consider it this way, the average household income in the US right now is about $52,000 per year. The average person retires around 67 and lives for another 15 years. So just to maintain an average standard of living in retirement, you'd need at least $780,000 in pre-tax dollars. That's $780,000 just for retirement. If you're a younger investor, it doesn't include things like buying a home. That's an extra $50,000 minimum just to get a down payment down on a home. College expenses for children, you're looking at $100,000 at a minimum, depending on how many kids you have. If you want to travel or enjoy vacations at any time in your life, you're looking at tens of thousands of dollars over the course of your life. And future medical expenses is the fastest rising cost for senior citizens today. And on average, the typical person over those 15 years will spend almost $250,000 just to maintain their health. So when you add it all up, you can see why we've chosen $1 million. When you consider that average portfolio right now is $50,000 and you need at least $750,000 just to be secure, the average retirement gap is about $700,000. That's a pretty frightening number. And the reality is, since the 2008-2009 financial crisis, investors face few to no choices for low-risk investments. And I'll show you that in just a moment. But bonds, savings accounts, CDs, all of those have been taken away from you. And the losses in the last market crash hurt investors so badly that they've been forced to catch up, typically with higher risk investments. And that actually puts your portfolio in greater danger. And for most of us now, that time model, the old adage, if you start at 25 and you invest $10,000 a year in an index fund for 70 years, you'll be able to retire with $1 million in the bank. Well, the reality is most people don't have those 70 years. Most people have 5 or 10 years to get to retirement. Many of you may be in retirement now. So it's not really hyperbole to say that, when I have that $52,000 per year statistic, and you're probably living on $20,000 to $24,000 less per year, that $28,000 is below the poverty line. So people are at risk of living their later years, frankly, in boredom, and we would like to avoid that. So when you look at the low risk part of the market, because you need to have a balanced portfolio, you always do, you have to understand that the low risk choices aren't available to you anymore. You must get back to investing in individual stocks. And that means sort of accepting some risk. And the reason for that is, and you can see this on these two charts here, that bonds, savings accounts, annuities, et cetera, they've all crashed worse than the stock market did. The stock market has recovered, but bonds, annuities, CDs, et cetera, they're paying interest rates that are 86% lower than they were 6 years ago. If you're in the bonds, the CDs and savings accounts, bonds are 50% lower yields on bonds. So stocks do continue to represent a safe way for you to invest if you can follow some relatively simple rules. But you have to understand that the market is no longer just sort of buy and hold. In order to get to your goals, you have to embrace some investing in individual stocks again. And understand that high frequency trading, computer algorithms, computer-based trading, they have changed the way that Wall Street works. And it is no longer an investing landscape such as we had 20 years ago, which means you have to make some simple changes or risk being left behind. Now, worse, relying on the government in your later years. So again, I want to help you prevent that from happening. So a quick introduction. My name is John Hutchinson. I'm the creator of the Millionaire Blueprint and the investing strategy that you're about to learn. I'm also a published author. My book, The Wealth Shield, How to Invest and Protect Your Money, can be found on Amazon.com. I'm also one of the publishers here at Traders Reserve and MainStreetInvestor.com, but I'm best known by our members and subscribers as a wealth building expert and strategist who helps people restore their retirement dreams while still protecting their wealth from risky or get-rich-quick schemes. So let's dive in. We were talking about stocks and the need to embrace some changes. And one of the first things I continue to see is that despite the rebound in the stock market, most investors today are making serious mistakes with their money and with the way that they invest. And it's the key reason most investors are having a difficult time getting their portfolios to grow consistently. And there's a reason for that. First, it's because most investors are following the same investing models of the last 15 years. Now, I already talked about buy and hold, the diversification between stocks and bonds, and even mutual funds in that model. But here's the reality. In that 15 years, of the last 15 years, the average return for most investors is less than 3% per year. And future returns, based on all the rosy economic forecasts out there, are expected to be around 7% per year. Now, you might think that 7% per year sounds pretty good. It certainly sounds better than 3%. Until you realize this fact. At 7% per year, you could put $10,000 every single year into the stock market, and it would take you 30 years to reach $1 million goal. That's if you put $10,000 into the market every single year, and if you get that 7% per year. Not only are there too many ifs in that scenario, but most investors just do not have 30 years to wait. But investors who want to achieve their retirement goals and still believe in the retirement dream, you can still get there, because in 8 years or less, and I'm going to show you how this is possible, this could be your portfolio. That's $1 million in about 8 years, and I expect you to be a little skeptical, but the purpose of this training exercise and this webinar is to show you how it can be done. And first, it's done by making one simple change in how you think about your portfolio. That change is to think in terms of time. In order to reach your financial goals, your portfolio should be structured based on how long you want to hold an investment, with a specific profit objective in each time frame. Now, today, we'll teach you how to use short-term investing in stocks to accelerate returns by compounding gains monthly, not annually, monthly. That will help you grow your portfolio faster than you probably think is possible. And to do this, you'll only use part of your total portfolio, depending on your total capital available, up to 10% of your total portfolio. So that will allow you to get explosive growth of your money, but it still keeps your overall portfolio safe. And in just a little bit, I'll show you how that's true. You'll also discover that you can hold fewer stocks in your portfolio, so it doesn't take hours of time to manage your money. But that brings me to an important lesson, something you may want to write down. The key to successfully growing your portfolio is determined by increasing the annualized rate of return on your money. Now, this chart that I'm about to share with you shows the growth of your money, if you had simply invested in the S&P 500 index fund, which is what many investors have done over the last 15 years, and you probably have seen that the market is making new highs, so you probably would think that if you had bought an index fund that you're raking it in. It's actually not true. It's one of the great lies about buy and hold and index fund investing. It decreases your annualized rate of return. Oh, sure, the market's up 25% in 2009 or 30% last year. But over the last 15 years, if you put $10,000 into an index fund, again, every single year, your actual rate of return was less than 3% per year. At that rate, it would take you nearly 50 years to reach $1 million portfolio. 50 years. So along with savings accounts, CDs, bonds, and now index funds, how are you going to get to that $1 million portfolio? It's called hyper compounding. And you can do this safely. You can do it consistently in your portfolio. It doesn't matter whether you hold a Roth, an IRA, a regular brokerage investing account. If you can buy and sell a stock, then you can use this hyper compounding strategy. Now, what is hyper compounding? Quite simply, it's a strategy to increase the annualized rate of return on your money by compounding your gains every month instead of every year. So let me demonstrate the power of hyper compounding to you. Let's assume that you're starting with $10,000 and you get an average return per month from your investments of 4%. Now, that's per month, not per year. After 12 months, you'd have $16,000. That's an annual return of 60%. Now, that 4% per month is the compounding strategy. Here's the hyper part. If you follow the same plan for a second year, starting with your $16,000 and still generating that 4% return per month, your money would grow to over $26,600 at the end of the second year, and your annualized rate of return is now 83%. And notice that in just 2 years, you've also more than doubled your money, but you never added a single penny to that original $10,000. So that's the power behind the hyper compounding concept. Let's get into some of the simple details behind the Millionaire Blueprint, however. This is what we call our power portfolio plan. And the only goal of this plan is to take advantage of monthly compounding of your money, but again, only using a small part of your portfolio so that you're not taking stupid risks with your money. So step one is to determine how much money you can start with. Remember that you're going to be investing in the short-term part of your new portfolio here. And the most important point, even if you have a larger portfolio, you do not have to take these big risks with your money. You can take a small part, 10% of your total portfolio, and allocate it to your short-term investing account. If possible, and this will make sense in just a little bit, you can start with about $10,000, although we've had people who have been successful even starting with just this $2,500. But the reason that you're doing this, the reason that you're splitting this into different little buckets, if you will, is risk management. It helps ensure that no one stock you ever invest in can hurt your overall portfolio. Can't tell you how many investors I've talked to in the last few years who have told me, they were holding stocks like GM and Citi and AIG and Fannie Mae, Freddie Mac, et cetera. All those companies that just absolutely declined 80 to 90% back in 08 and 09. And of course, those investors all sold out at the bottom, and so they lost all their money. But even if you have less money to begin with, I will be honest with you about this. You have to take on a little more risk because you need faster growth to get to that $10,000 point. But again, more on that in just a couple of slides. Once you've decided how much money you'll start with for your short-term and hyper-compounding investing account, the next step is to divide that capital into 10 equally weighted buckets, if you will. So if you're starting with $10,000, you'd have 10 buckets, each with $1,000 in it to start. Each bucket would then hold one stock at a time, so the maximum number of stocks that you would ever hold is 10. This is an additional risk management tool to reduce your overall risk exposure even more. So again, this step protects your portfolio from those big losses that most people experienced in 2008, 2009. Now, those are the two key steps to get started with the plan. You're beginning with a short-term investing to get that fast growth of your money and to begin the hyper-compounding process. What you'll discover is Most of our short-term investments that we hold are held between 30 and 90 days. Now that allows us to start creating the process of monthly compounded returns. Now there's more to the Power Profit portfolio, however, which includes the ability to roll a stock up to a medium or long-term part of your portfolio, but we'll only be focusing on the short-term part in this training session so that we can keep it simple. But here are some things that you can expect to happen in the future. Some short-term stocks would be held for up to 6 months for twice the original profit potential, and some for up to a year for potentially 5 times the profit potential. But I'll remind you here that this is not day trading. Short-term investments are stocks or other assets that would be held from 1 to 3 months, and most importantly, have a specific profit objective. That's coming up in our next section called the rules, and I'll cover that in just a moment. But once that profit objective is reached, you take your gains, repeat the process, and this is how you begin to tap into the monthly compounding or hyper-compounding strategy. In our Millionaire Blueprint program, we target between 2 and 8% returns monthly, which gives us a potential annualized rate of return of 80%. And what you'll discover is that you'll make more money faster with just part of your portfolio by using short-term investing with these goals in mind and never risk losing it all. But that brings me to the second of the sort of costly mistakes that many investors are making, and it segues us into the rules part of this training. And that mistake is that hope is not a strategy. To be successful with this or any investment plan, you must have 3 things: a simple, repeatable plan to come out ahead, easy to follow rules that don't take a lot of time, and a smart way to protect your money. But why do most people actually lose money? In one word, emotion. To understand why, I'll share a little story here. A number of years ago, I was on a flight out to Las Vegas, and I was sitting next to a guy from New York. Turned out he was very successful, and we were talking about gambling. So I asked him why he thought most people lose money in Las Vegas. And here's what he said. He said, people lose money because they don't have triggers to quit. Their emotional highs or lows actually get in the way of making a rational decision. He said, I have 2 triggers, a profit trigger and a loss trigger. Whichever one I hit first, I pull that trigger and leave the tables for the night. Well, the more I thought about that idea, the more I realized that it's the same principle when you invest. You have to have triggers. But most investors don't have a loss trigger. They have a hope trigger. They just hope the stock will come back. And they don't have a profit trigger. They just hope the stock will keep going higher. But think about the last time that you bought a stock. Did you ever think any of these things to yourself? Well, I hope this one works out. Or have you ever had a stock that went down by 10 or 20 or 30% and say, I hope it comes back? Have you ever had a stock that went up by 10 or 20 or 30% and say, come on, baby, keep on going higher? And what happened next? The stock went down, you gave back all your gains, and you were back to square one. That's why hope is a recipe for disaster. That's why hope can wreck your money. As part of our Millionaire Blueprint rules, I'll give you the key to success. Remove emotion from the equation. Now, I'll be honest. I get excited too when I have a stock that goes up, and I get mad when I have a stock that goes down. There's no way to remove emotion at all angles. But what we do want to do is use what we call decision triggers. We can remove emotion from the equation, and by emotion I mean fear, greed, and hope, by using profit triggers and loss triggers to establish a profit target and our risk in advance so that we can automatically secure an investment gain or protect ourselves from a big loss. That's because when you learn to use decision triggers, you're making your decisions before you commit your money to the stock market or any investment for that matter. So I'll say that again. With these triggers, your decisions are made before you ever put money in the stock market. So let me teach you now our Millionaire Blueprint 2010 rules to investing. And then in just a few minutes, I'll even share some trade examples so that you can see decision triggers in action and how they do both secure that investing gain and protect you from a big loss. But let's quickly review the plan again. And remember, your first 2 steps were to determine your short-term investing capital base. We'll assume $10,000 for our teaching purposes here today. Oops, sorry. And then next up, you divided that capital into 10 equally weighted buckets, each bucket being worth $1,000. Next, we need to set our decision triggers. We need to make our decisions before we commit our money to the market. Those decisions for short-term investments are a 20% profit trigger and a 10% loss trigger. Every stock we're investing in for short-term investing has the same profit and loss triggers. This is how you secure your investing gains and prevent big losses. You'll use decision triggers to make the only important decisions necessary. When you hit your 20% target, you want to take your gains so that you start the hyper compounding process, because you'll use all of the capital from that first gain on the very next trade you make and continue repeating the compounding process. The main benefit to your money here is also to make sure that you never ever give back a big gain. And by give back, I mean give back the whole 20%. That's why when that 20% trigger is hit, you pull that trigger, exit the trade, take your gain, and move on to the next opportunity. Next, you have to protect your money, and to do that, you'll use a 10% loss trigger. Let me be clear on something, however. A loss trigger does not have to be a stop loss order, and in many cases, it should not be. The reason is, especially with small cap stocks, is to prevent market makers from intentionally driving prices down to your stop loss and taking you out. Many people have that fear, and it's a rational fear because it does happen. But at 10% below your entry price, this gives you a chance to analyze your stock. Are the fundamental reasons for owning the stock still true? Has the company reported negative or positive news? If so, if it's negative news, for example, when this trigger is breached, that's the time to preserve capital and move on to another opportunity. Simply put, the 10% loss trigger ensures that you never let a small loss turn into a big loss, which is exactly what happened for most investors in 2008, 2009. They watched as stocks drop 20, 40, even 80% in value and never protected themselves with a loss trigger. When you put all of this together, the plan and the rules, what you'll discover is that you don't have to be afraid of hitting singles and doubles. Winning in the markets is just like playing baseball. You'll score more often and with realistic gains by consistently hitting those singles and doubles rather than swinging for the home run trade at every at bat. So far, we've had a chance to cover the plan and the rules. There's one final piece that I want to walk through here before I sort of teach you how to, or let you get your hands on the whole Millionaire Blueprint plan. And usually I have a second half of my team here with me, Jamie DeLuga. She wasn't available this afternoon, so I'm going to carry through with the right stocks part of our portfolio, because obviously you have a plan. You have a simple set of rules to use. Now you need to know how to find the right stocks. So if you don't know Jamie, he's my partner here at the Millionaire Blueprint program. He's a 25-year veteran of the stock market and an investment professional. Hulbert Financial Digest previously ranked as Rational Investor a #1 newsletter. He currently writes for reputable websites that include Traders Reserve, Main Street Investor, MSN Money, and others. He's also the author of a forthcoming book, Manipulators, Beating Wall Street's Earnings Game, which is due out next month. And the process that Jamie uses to find the right stocks for our Millionaire Blueprint plan and rules centers on one number. Now, you'll learn how simple this number is to calculate in just a moment, but as the expert in the Millionaire Blueprint program, he uses a computer-based algorithm which ranks all of the publicly traded companies at the end of each month. He then reviews those rankings by sector and market cap to avoid overexposure to any one sector or too many large or too many small cap stocks. And then next, he uses a qualitative analysis approach to re-rank stocks into his top 10 stocks each month. These are the 10 stocks that we use, or that you would use, in your short-term investing portfolio. Remember, you had $10,000, you divided it into 10 capital buckets. You now have 10 stocks to fill those buckets with. And they are all based on one number used to identify the best stocks to own. That one number is what we call the PE gap. Now, a PE gap occurs when there is a difference between a company's PE ratio and the company's earnings growth rate. Now, this is a fundamental analysis tactic. It's very easy to do. You may not necessarily have expertise or know how to calculate a PE ratio. I'll show you. Or an earnings growth rate. I'll show you that too. But don't worry about getting sort of bleary-eyed here. And really, this is very simple and very easy to calculate this one number. Here's what you're looking for are essentially these little pieces. When the price to earnings ratio is greater than the earnings growth rate, that means you have an overvalued stock. That's typically a stock that you'd want to avoid. When the PE ratio is less than the earnings growth rate, that means you have an undervalued stock, and that's one that you would typically want to buy. The objective here is to buy growth at a discounted price. Just as you would when you go shopping, you're looking for good deals. This is a way for you to find the best deals in the stock market. You're buying substantial growth at a substantially discounted price. Now, a little tip, and you'll see this in the moment, the wider the gap between the PE ratio and the earnings growth rate, the better the profit opportunity can be. And that's because we frequently see PE gaps trigger gains of 15% to 30% in short-term investing timeframes. And if you think back to our rules and our decision triggers, what was our profit trigger? 20%, which is right in the sweet spot of the types of gains we consistently see in undervalued stocks using this PE gap one number approach. Let's take a look at a quick example, and then I'll teach you how simple this one number is to get. This is Manitowoc, stock symbol MTW. They're a heavy crane manufacturer, and they were a stock which our PE gap approach identified at the end of November 2013. At the time, the stock had a PE ratio of 16 and an earnings growth rate of 19, which yielded a -3 PE gap. Now remember that when the PE ratio is less than the earnings growth rate, we have an undervalued stock, and that's a company we would want to buy. Here, we recommended MTW at the beginning of December 2013 with an entry price of $20.59, and you can see how rapidly the stock was repriced by Wall Street. In just 30 days, the stock reached that 20% profit trigger. Some of our followers even held on longer and enjoyed double that return in about 90 days. That's how powerful this very simple approach can be for you. Fast gains, which you then turn over into another stock for another gain month after month. But let's get back to the lesson on PE gaps here. And this is the quick lesson, the easy way to know what to do. When the PE gap is negative, that means the PE ratio is less than the earnings growth rate, which means the company is undervalued today against the future expectations of the company. That's a stock you want to buy. When the PE gap is positive, that means the PE ratio is greater than the earnings growth rate, which means the company is overvalued today against future expectations of the company. That's a stock you want to avoid or even potentially short. Now, we don't do shorting here in the Millionaire Blueprint program, but you can if you were doing this on your own, for example. Now, last but not least, remember, as I said before, the wider the gap between the PE ratio and the earnings growth rate, the better the opportunity for short-term gains. So let me show you how simple the PE gap is to calculate. Really, you can do this right at home along with me if you want to. First of all, we use Yahoo Finance to get the numbers, the information that we need. Any financial portal you will do, provided that you can get the three numbers that you need, which are the current stock price, the current year's earnings estimates, and the next year's earnings estimates. That's it. Those are the only three numbers you need. Now, on Yahoo, if you type in a ticker symbol and then scroll down the left-hand menu, which you sort of see on the screen there, you'll see a tab called Analyst Estimates. That's the tab you want to get into the earnings estimates and get the two numbers that you need. Now, we're going to use American Airlines here in our example. And once you're on that analyst estimates page, you can see the three numbers that we need are outlined in red for you. Our current price here was $51.40. Current year's earnings estimates were $5.72, and next year's earnings were $8.42. Now, please note that in full disclosure, this snapshot was taken on December 22nd of 2014, so just a couple of months ago. It's the process that is important here. So this is the process of calculating the PE gap on any stock you own. So we have the three numbers that we need, and we can move on to our fifth grade math lesson. Yep, this is so simple, a fifth grader could do this. Step one is to calculate the price to earnings ratio. To do this, you divide the current price by the current year's earnings estimate. So with our American Airlines example, that's $51.40 divided by $5.72, which gives us a PE ratio of 9. Now hold on to that number for just a minute because we'll come right back to it. Next, we need the earnings growth rate. To get that number, you divide that number, you divide next year's earnings estimate by the current year's earnings estimate. So back to our little calculator and example with American Airlines, we'll go, and that would be $8.42. That's next year's estimate, divided by $5.72. That's this year's estimate. That gives us 1.47. In order to get a percentage, you have to subtract 1 from that number, which means we have an earnings growth rate of 47%. Now again, save that number because now we want to calculate the PE gap. That is very simple to do. You subtract the earnings growth rate from the PE ratio to get the PE gap. So for American Airlines, we had a PE ratio of 9 minus the earnings growth rate of 47. You don't need the percent here, just the raw number, which gives you a negative PE gap of minus 38. So our gap is negative, which you'll recall that means that the company is undervalued and we'd want to buy this stock at current prices. So now let's bring everything together. The plan, the rules, the right stocks, all of this together so that you can see this in action. And again, we're just going to stay with American Airlines because this was an actual recommendation that we made at the end of September 2014, so just 5 months ago. We would have used one of our capital buckets to buy this stock at the market open on the first trading day of October 1, 2014. The opening price on that day was $34.50. So I've pretty much already given away how this trade turns out if you've been paying attention. But first of all, you have to make your decisions, right? We have to make our decision triggers or set our decision triggers before we commit our money to the market, which means we need to set our profit and loss triggers. Now, here's how easy they are to get. For our profit trigger, you multiply your entry price by 1.2. So that's $34.50 times 1.2, which equals $41.40. That's our profit trigger. Next, our loss trigger, you multiply your entry price by 0.9. That's $34.50 times 0.9, which equals $31.05. That's our loss trigger. Finally, we step back, we let the market do the work for us, and let the trade run to conclusion. But before I get to that, I do want to share a little secret with you, something that we do in our Millionaire Blueprint program that you'll want to learn to do as well. Remember earlier when I talked about loss triggers, I told you that it's a decision trigger, and you have to assess whether something fundamental has changed with your stock when that loss trigger is breached. In our program for members of the Millionaire Blueprint family, that's what we do. When a stock reaches that 10% floor, we instantly advise members whether to close that trade or hold the trade and the fundamental reason for doing so. Here with American Airlines, you can see that big red dip right at the outset of October, 6 big red bars right about in the middle of your screen. You may remember the CNN and MSNBC and ABC and CBS and NBC hysteria back at the beginning of October. It was all around Ebola. Recall the healthcare worker from Texas who took a commercial flight to Cleveland while exposed to the Ebola virus? You're looking at 6 days of headline selling. In other words, mass hysteria, which actually translated into all stocks in the airline sector being sold off by 15 to 25% in 1 week. What did we do? We sat tight. Why? Because nothing fundamentally had changed about American Airlines. Their earnings expectations did not change. And in fact, oil prices were in that acceleration down, which meant more profits for the airlines to come. And passenger traffic for that period in time around the Ebola scare didn't change, not one bit. So we sat tight and we were right. Within 20 days following that headline hysteria, we hit our 20% profit target, 20 days. Now that wasn't enough for us though. You'll recall in the pie chart earlier, there were also medium and long-term parts to the power profit portfolio. So we moved American Airlines to our medium-term portfolio with a 40% profit target. And we're still following simple rules. We've just increased our profit trigger. And within another 30 days there, you can see that we had reached that 40% target. That still wasn't enough for us, so we actually have moved it to our long-term holding, where it currently has a running return of about 55% and a potential profit target of over 100%. And if you've been following the news, you know that American Airlines was just added to the S&P 500, which means it will continue to see an acceleration in the growth of its stock price, in part because index funds are going to be forced to add it to their portfolios. Now, let me be honest. That's luck. We had no way of knowing that American Airlines would be added to the S&P 500, but we'll certainly be the beneficiary of that move. So now, more fun stuff. Let's do some more examples. I'm going to show you the losing side and how the plan and the rules actually protect you from those big portfolio wrecking losses. This is US Silica. SLCA is the stock symbol. It was a November 2014 recommendation, which at the time had a negative 35 PE gap. That's a big gap. However, we were cautious with this one because it's tied to the oil industry. And obviously at the time, oil prices were still in that big move down. So nevertheless, we had an opportunity. We took it. But again, we have to make our decisions first. So we want to calculate our profit trigger and our loss trigger. The opening price at the first trading day of November was $45.57. So our 20% profit trigger was $54.68. And our 10% loss trigger was $41.01. So we've set a ceiling, we've set a floor, we're following our rules, we have a fundamental basis for making this trade. Let's see what happens next. And that's not a real pretty chart. Here's what happened and here's what we did. Oil continued to fall dramatically right at the beginning of November. That's a fundamental negative. So within 2 days, our 10% loss trigger was breached. We told our Millionaire Blueprint members to close the trade. And the reason why was because the fundamental reason originally for making the trade, that being the stabilization in oil prices, was not happening. Ultimately, we closed the trade the very next day at about an 8.5% loss. Now, to put that into dollar context for you, remember, if you start with $10,000 and divide that into 10 capital groups, that means you would have used $1,000 on US Silica and American Airlines before it. With a 10% loss trigger in place, that means your maximum loss, your maximum risk is $100. That's it, just $100. And that $100, that $100 is just 1% of your total short-term investing portfolio. So you should be able to see there how even a losing trade, because they will happen, doesn't wreck your portfolio. More to the point, and as an opposite call on American Airlines, look what would have happened if you had held on to this trade. By the end of November, the stock fell all the way down to $28 a share. That means we saved ourselves and our members from a potential 34% loss by executing our decision trigger, taking a small loss, preserving 90% of our capital for our next trade. However, lest you let one losing trade get you down, in the very same month of November, we also recommended automotive supplier Meritor, stock symbol is MTOR, which at the time had a negative 20 PE gap. You can see there the PE ratio of 15, the earnings growth rate of 35. You subtract those numbers and you get a negative 20 PE gap. So from there, we'll go back to our rules again. And we'll set our decision triggers based on the market opening price on November 3rd, which was $11.55. So our profit trigger is $13.86. Our loss trigger is $10.40. We've made our decisions. We let the market do the work for us. And boom, it happens just that fast. 9 days later, we had another 20% winner. Ultimately, we also moved this one to our medium-term portfolio where it was still holding its gains on its way to 40%. So in the same month, across those two trades, you would have had one trade that lost 8.5% or $85 and one trade that gained 20%. That's a $200 gain. So across just those two trades, you would have been ahead by $115 or 1.15% in your portfolio. But let's sort of look at a full run of action in our plan, and from the plan to the rules to the stocks. And what I'm going to show you here in just a second on this next slide is our February run. We had 10 stocks in our short-term portfolio, and the total return across all 10 of those stocks was nearly 9% for the month. So I want to show you how that happened, but I'll put all of the pieces together for you. And so you can see how powerful this is when you put the plan, the rules, the right stocks, all of it together. So here are the 10 stocks that we recommended and the calculations of our PE gaps. Now, we do this for our members in the Millionaire Blueprint family every month. So basically, we do all the work for you. You push a couple of buttons, you lucky devils, and you get all the gains. So look at the spread of gaps here, though, from -10 to -260. And you'll notice that none of these are penny stocks or OTCs or pink sheet stocks. I mean, USG is a home builder, Whirlpool, Bank of America, United Airlines. So here's what would have happened for you in February, again, bringing the plan, the rules, and the stocks together for you. If you were starting with $10,000, and you would have had a total invested capital of $9,648. That's just based on share prices and commissions. So to make this as real world as possible, I'm accounting for both cash and commissions in this example. Total commissions probably would have been somewhere around $70, depending upon how much your broker charges you per trade. And you would have had excess cash of $281. And that's basically, you wouldn't have been able to use 100% of each of your 10 buckets based on the stock prices. And that's because you can't buy fractional shares. So by the end of the month, these 10 stocks one of which included Bungie, which closed at a 10% loss, had a total value to you of over $10,800, which means for the month, you had a 9.2% gain in 1 month. And if you'll recall, I told you that most investors are making 3% per month, or per year, excuse me. Here's 9% in 1 month. And note the consistency in turning in the next slide, I'm going to show you this. You'll see the consistency in turning in positive months. But when you look across the returns there, you see some of the stocks moved, some of the stocks had modest gains. Cons was a huge trade for us right at the beginning of February, almost 30%. And the reason it's 30% instead of 20% was because it made a gap up move and literally jumped over the 20% target. So this was again a lucky move on our part, or lucky result, in that we were able to close the trade with a substantially higher gain because of that move. But even the stock, 1 out of 10 stocks here lost 10%. All of the rest did very, very well. And the smallest gainer there was UAL with just under a 1% gain. So, but you could see a bridge of gains. Now, some of these stocks we would have carried forward into the next month to try to continue holding on for additional gains to get to that 20% target, which is what we would normally do. Because remember that we'll hold stocks up to 90 days to get to that 20% target. But here's an example of a sort of the full run since August of 2013. And again, even in months when the market has been down, we've still been able to turn in positive returns for the month. So in the 16 months that we've been running, we're averaging 6% per month. And I told you at the outset that if you had started with $10,000, you could get to $1 million in less time than most people pay off a car loan. Well, the way that you do that is if you average 5% per month, and we're beating that number right now, you'll be able to build your portfolio to $1 million. Maximum time is about 8 years at that 5% per month, but that's still going from $10,000 to $1 million in about 8 years. And you'll never need to add a single penny to your account. Even if you close losing trades, you still don't need to add money to your account. That's how powerful this program can be for you. It's also why we say that it's the only step-by-step investing plan designed to create millionaires. It includes everything you need to achieve financial success. So you have the plan, just as I've taught it to you here today. You have your decision triggers, just as we use them in the Millionaire Blueprint rules, and as you've seen in action here so far. And you have the ability to get the right stocks to use with those triggers and your plan based on the one number formula, just as you've seen me teach it to you here today. So today I'm going to give you a choice. You can join our Millionaire Blueprint family and speed the growth of your portfolio, or you can risk going it alone. I'll remind you, though, that going it alone means that it could take you 36 to 60 years to reach your financial goals. So if you want to save yourself 40 years, then I want you to reserve a seat in our Millionaire Blueprint program today. You can choose to join us for our simple, no-hassle 60-day test drive for $79. That gets you complete access to the entire program. Not no half access, limited access, none of that. 100% complete and total access for 60 days for $79. Yes, that's $79. Now, over the 60 days, you'll have 2 full months of complete access to the Millionaire Blueprint investing plan, which includes our 10 short-term stock selections each month. That's 20 total stock selections over the next 2 months. So you'll be able to know right away how fast this plan can work for you and how quickly we can help you get to your investing goals. Now, here's exactly how the program works for you. And in just a moment, I'll tell you how to get in and reserve your spot. First, we make our new monthly trade recommendations at the end of each month. So we're about a week away from making our recommendations for April as it is right now. Sorry. Remember that this is short-term investing. It's not day trading. So our goal is to turn over our portfolio as frequently as the market will allow so that we're compounding our money from month to month. That's the hyper compounding strategy that we're using to get explosive growth in our portfolio. Again, our maximum holding time is 90 days. You've seen already how quickly some of the trades can move in our favor, as little as 20 days. Now, next, once you have those stock selections at the end of the month, you'll enter your trades on the first trading day of each month. Now, we're not market timers. We're not technical traders. We're not using some weird convoluted scheme. We want to get in, get our money working as simple and as quickly as possible. Once you've entered your trades for the month, you follow the rules. We'll guide you. And those are your decision triggers, your 20% and 10%. Again, we'll be guiding you every week along the way. You'll never be alone. Just like I showed you with American Airlines and with US Silica, when there's a decision to be made, you can be secure in knowing that we're going to tell you what that decision should be and why that decision is the right one. You'll also get updates and alerts every week when there's an action to be taken. I'll include some more detail on that in just a moment, but that includes email and text message alerts so that you always know when to take the necessary action. When our 20% triggers are reached, we'll close the trades, take our gains, and move on to another opportunity the following month. Now, unfortunately, a small group of you here, but there are 41 seats available for April. So you want to act quickly because there's also a deadline of Tuesday, March 31st at 7 p.m. Eastern time. That's when our next monthly stock selections will be in your hands. And we'll put the link up here right now. Give me just a second. I'm going to put it up in the admin notice box and also in the chat so that you can, there's also a pop-in box by the chat so that you can just instant click and get yourself a seat right away. Really do it now and save yourself that 50 plus years. But once you join, here's what you'll be getting. First, again, on the last day of each month, you will get your Millionaire Blueprint stock selection, your monthly stock selection report that includes the complete short-term investing portfolio, up to 10 total stocks for the new month and for using with the 2010 rules to investing. Next, you'll get our 2015 $1 Million Portfolio Blueprint Report. This details the short-term investing portfolio plan, the 2010 rules, the PE gap methodology. Just as I've taught everything to you here, this is your report to keep, hold, stay, saved by the desk so you always know what to do. You'll also get regular trade alerts and updates every Tuesday and Thursday by 7 p.m. Eastern time. You'll get our midweek updates by email. Every Saturday morning is our comprehensive Saturday review where Jamie gives you an in-depth look at all of our open trades, the returns for each trade, key events driving our stock selections higher. You'll also get our action to take alerts via email on the members website, on the members website and via SMS or text message. So whenever we want you to close a trade, you'll know exactly what action needs to be taken and when to take it. You'll also get 3 free bonus reports. Our Advanced Profit Strategies report teaches you 2 simple strategies to use: the risk reduction strategy, which shows you how to recapture your trading costs and how to eliminate nearly all risk in any trade you place, and the active investor rules, which show you how to capture larger gains from a winning trade by taking just one simple little step. You'll also get our $2,500 plan report. For those on a limited budget or with limited funds to get started, this report will help you get to that $10,000 starting point in about 12 months, while still following the Millionaire Blueprint plan and the 2010 rules to investing. Finally, our capital management spreadsheets. These do all of the work for you in managing your 10 buckets in the program. There's even a training video to help you use the Excel spreadsheets in your very first month. You'll also get our fast track to success with the Millionaire Blueprint bootcamp video. This video walks you through step-by-step how to get ready for your very first Millionaire Blueprint trades, how to let the capital management spreadsheets do all the hard work for you, what your expectations should be, and how to spend more time doing what you enjoy doing, because you'll know that we're doing all the hard work for you. Then each month, we hold up to 2 live strategy sessions with Jamie and me, where you'll be able to keep on track for success. We'll help you by answering any questions that you have, review the portfolio, review the trades we've made. We'll also do special training for our members on other related topics. All of that's included in your Millionaire Blueprint test drive. We're holding our next live webinar with our members on March 29th, Sunday at 7 p.m. So as soon as you join, you'll be able to reserve your seat in that upcoming strategy session. I'll show you how to do that in just a moment. But you also get our Millionaire Hotline email. This is direct access to me and Jamie via a special email account so that you can get your questions answered fast. Consider it your lifeline for instant help. You also get access to your Millionaire Blueprint members-only website where everything you need can be found in one easy place, including the trade alerts, the updates, all of the reports, the bonus materials. You can easily download the monthly stock selection reports. Again, they're also emailed to you. You grab your Saturday review every Saturday morning at 10 a.m. Remember, this is when we'll update you each week on the overall performance of our trades. You'll make sure to know, or so that you can make sure you know which stocks you should be holding, whether or not there are any actions to take. We'll also be taking a look at each company in the short-term investing portfolio so you know what's affecting the stock's price and what we expect to see in the near term. You'll never miss a strategy session either, because you can always access the recording archive to keep up with all of our members-only strategy sessions. And whenever our decision triggers are reached, you'll have immediate access to the trade alert on the members' website. You'll also get that via email and via SMS text message, so you'll always know what to do. Plus, our unique calendar gives you a quick glance at what's on the schedule for the week and the month ahead. You'll always know when to register for your next strategy session, when our reports or special events are taking place, and much, much more. Also on the members' website is the easy one-click access to all of your bonus reports and training materials from the Millionaire Blueprint plan, the free bonus reports, the PE Gap training module, which we just added, the capital management spreadsheets. Everything's a single click away and easy to access. Again, now that's a ton of value that most other programs don't bother giving you. From stock recommendations, ongoing access to your Millionaire Blueprint experts, access to 700 plus members in the Millionaire Blueprint community, the bonus reports, the capital management spreadsheets, instant access email support, training videos. You get all of that in our no hassle 60-day trial for just $79. No other program provides a complete step-by-step investing plan where all of the work is done for you. Again, you get the $1 Million Portfolio Report, the members only website, our special bootcamp fast track training video, 2 months of stock selection reports with up to 10 stocks each month. So that's 20 total stock selections in the next 2 months. The ongoing trade alerts, email updates, the Saturday reviews, the 2 bonus reports, the capital management spreadsheets, our instant answer millionaire hotline email support, all of that for $79 for the next 60 days. But again, the deadline is 41 seats or Tuesday, March 31st at 7 p.m., whichever happens first. Now, once you've completed your 60-day trial reservation form, you'll be taken to our welcome and thank you page. Please take 2 minutes to watch my short video because it tells you how to make sure that you get the 2 confirmation emails you need, including the one that has your login and password information. As soon as you have that second email, you can instantly log into your members' website. And once you have logged in, I want you to do this one thing first. I want you to register for the strategy session that we're holding with our Millionaire Blueprint members community on Sunday, March 29th at 7 p.m. It will be recorded and then added to the members site under the strategy session section later that night. But for those who want immediate help, make sure that you reserve that seat right away. Now, this is an older slide, so it says March 1st. When you get into the members website, it'll say Sunday, March 29th at 7 p.m. And we'll also be looking ahead at our potential stock selections for April in that strategy session and making sure that everyone's questions are answered. So when you get that first stock selection report, you'll have the April short-term investing portfolio. That's 10. That'll be 10 stock selections. Before you get started, one of the things that you should do is watch the Millionaire Bootcamp training video. This is in the bottom section of your members login page. It is a longer video, so don't try to watch it all at once. You can do it in 15 to 30-minute segments, but this will get you prepared for that first stock selection report so that you know exactly what to do when you get those stock selections and need to enter those trades on Wednesday, April 1st. Now, inside your stock selection report, again, I told you, this is how you access it. And inside the report, you'll get the 10 stock selections for the month. You'll see that we do all the PE gap calculations and analysis for you. So again, you'll know why each of the companies have been recommended. And then we take a quick dive into the analysis of each company and give you exact buying instructions. Now, remember, we use market orders, not limit orders. We're buying our 10 stock short-term portfolio on the first trading day of each month. And again, we're not market timers. We're not trying to be cute with how we get into the stocks. We want our money working as quickly as possible. And you may be wondering why we don't use limit orders. And the simple reason is it's to ensure that all members can get their orders executed. Market orders guarantee that, limit orders do not. And this way, you know that you'll be able to capitalize on every one of our stock selections. You're not going to miss out because you couldn't get in on a good thing or at a good price. And the same is true when we exit a stock. We'll keep it just as simple for you to make sure you can get out with those 20% or better gains. Now, I'll cover much of this again on that Sunday night strategy session, but here are the step-by-steps. Once you have your stock selection report, you'll enter your trades on the first trading day of the next month. That's April 1st, Wednesday. Note that you can enter your trades even the night before by estimating the number of shares to buy, but the capital management spreadsheets, which you can download as soon as you join, will do all of this work for you. The next step is to simply follow the rules of investing. There's 20% and 10% triggers. Follow the Tuesday, Thursday updates and the Saturday review. We'll always be telling you what to do. You'll get your trade alerts and exit alerts sent via email or SMS or on the member's website. So you'll always know when to take the action that's necessary. When our 20% triggers are reached, take those gains, close your trades with a profit, and repeat the process the next month. That's it. It's that simple. And based on our returns, again, averaging 6% per month since 2013, you'll enjoy a stress-free investing plan that gives you back time with your family, time to do the things you want to do instead of worrying about which way the market's moving today or what headline CNBC is using to scare the pants off of you. You'll discover that Jamie and I do all of the worrying for you. You're never alone with the Millionaire Blueprint program. This is an important thing to understand. We're with you every step of the way. We're giving you all the tools you need to be successful and to build a secure portfolio that's never at risk of losing it all. So don't wait thinking that you'll do this later, because later never comes. As we've shown you, most investors don't have 30 years to wait to be financially secure. You don't have time on your side. Reserve your 60-day trial immediately. Let us show you what successful investing really looks like. I'm looking forward to seeing you on the Sunday night strategy session on March 29th and getting you off to the best start possible. Now, again, it's a 60-day trial for $79. After the trial concludes, you may choose to continue on for $79 per month, or you can upgrade to an annual membership and save 33% after you've made absolutely certain that this program is right for you. Now, we realize this investing plan is unique. It's different because most investors don't have a set of rules. It works because we get you in and we get you out of most of the trades, whereas most programs, they get you in, but they never do anything to get you out. And because of that, we know this is not for everyone. Only you can decide if you want to take control of your financial future or whether you want to try to survive on government handouts and lottery tickets. As I said earlier, this is not a get-rich-quick scheme. This is building wealth slow, steady, and smart. And again, we're buying undervalued stocks at a discounted price. We're buying value at a discounted price. So you're always protecting your money first and taking your gains when they happen second. And that right there is why this investing plan can work for you. Now, you can go it alone. But as I've shown you, buy and hold and traditional investing will take you 30 to 60 years to reach your goals. I'm offering you a safe, smart shortcut to slash your waiting time to about 8 years. If you're in, reserve a 60-day trial right now. Now, again, there's a deadline. There are limited seats available, but start learning immediately so that you're ready to place your first profitable trades on Wednesday, April 1st. Now, I'll check the Q&A box and see if we have any questions. If not, I know it's ran over a little longer than I had anticipated, but if we don't have any questions, it has been recorded and will be up and available to you to review sometime in the next hour. We'll email you and let you know, and you'll be able to access that. And make sure I get my voice back here. And all right, what is compounding time after paying quarterly income tax on short-term capital gains? And it's taxes are a good question. Taxes are an issue, obviously, with short-term capital gains. It's not a question that I can actually honestly answer for you because I don't know your tax situation, nor do I know anyone's. I can tell you that two things that are of most importance here are taxes will not severely limit your ability to reach this goal in the time frame that we've established. And you don't want to make a decision because of taxes. Paying taxes, frankly, if it means that you're making money with your investments. Yes, we all hate having to pay taxes, but the only way to grow your money is in the way that we've expressed here. So I get it. I know that taxes are a relevant issue. We do deal with it in general terms. We're not tax advisors. And no two person's tax situation is ever the same. So it makes it very difficult to give you an honest answer because of that. It's not that I can't give you an answer, it's that there isn't an answer for me to give you. So I hope you understand the distinction there, and I apologize that I can't be more demonstrative in terms of absolute numbers. Next question that I hear, are there any backtesting results? No, you can't backtest this in part because of the PE gap methodology. Jamie has been using that methodology for over 10 years. His previous newsletter, as I said before, was ranked as a #1. The problem with trying to backtest results around the PE gap methodology is you don't have the actual earnings estimates prior to when a trade would have been made. Because once the earnings have gone away, the estimates don't exist any longer. So regarding the stock selections, I'm assuming it is recommended to take all 10 trades based on the plan. That's correct. You want to take all 10 trades for the short-term investing portfolio. The reason we do that is we keep everyone on the same page month by month. From time to time, we may tell new members not to execute on a certain trade, usually because it's already made a pretty significant run, and therefore your potential gains are too limited, and it doesn't make sense to make the trade. But you'll make all of the new recommendations for April as we get underway. And it's actually a favorable month because March has been a down month in the overall markets, and our portfolio right now is trading at about a 1% gain for the month. So that's overall, that's not bad. But what it means is if we do carry any of those trades over from March to April, you'll actually be able to get in at fairly favorable prices. Clark asks, what capital required to play all positions recommended? Actually, Clark, $10,000 will allow you to have 10 individual buckets and to utilize all 10 of our recommendations in the short-term portfolio. And then even if we move positions up into the medium or long term, you can simply do a capital replacement in the short-term portfolio. So by that, I mean just add capital back in to replace a stock if it moved up a level to the medium-term portfolio. But $10,000 is all you really need to get started. Any other questions? I know there's about a 60-second delay, so I'll try to hold tight for an extra minute here and then hopefully get everybody off to the basketball games. Looks like we're good on questions then. I want to thank everybody for your time today. And again, there will be a replay of this available to you shortly. It'll come to you via email. If you have joined us, thank you. We look forward to working with you. If you have not, do it. We will help you. Give us some time to prove it to you. I know you probably haven't heard of us and worked with us in the past. You'll find how an investing service should be run. But we look forward to talking with folks. And never a problem with Pacific time. No, we don't have. We give you more than enough time for executing trades, more than enough notice for executing trades, Clark. So remember, you're getting the stock selection report the night before we want to do market entries. So even with a Pacific time, you'll still have more than enough time to execute those trades. Actually, you'll have 3 extra hours. And then the other aspect to that is when we're exiting trades, we typically give you a notice of the day in advance. So, for example, if we hit our 20% gain, even if it's intraday on a Tuesday, then we will tell you to exit that trade on the next day, typically after 10:30 in the morning, just to allow for the first hour of trading to subside. But we give you more than enough advance notice in terms of exiting the trades as well. Oh, I'm sorry, pattern day trading, Clark. Thank you for clarifying that. No, it's not, because even those stocks that have moved rapidly, they still take typically 3, 4, 5 days. That's the shortest time that we've ever seen a stock close at a 20% gain. But you're not going to get classified as a pattern day trader because you're holding positions longer than 24 hours. Blank asks, if you were taking on all 10 trades per month and start with 10K, how do you ensure you have capital left over for next month's 10 trades? Because some of those trades will be carryover trades, in which case, you start with XYZ in April and we want to carry XYZ forward into May, then it's holding in that one same bucket. You're not rebuying that stock the next month. You're simply holding it because it hasn't reached its full potential. So, for example, let's say we started with 10 complete trades in April. So you're filling all 10 buckets, and then we go to May, and we're going to hold 5 trades. Then what we would have are 5 new trades to fill the 5 open buckets. So we're keeping everyone on essentially the same 10 stock short-term portfolio from month to month, and we are replacing open buckets with new positions every month. Generally, you'll find that we're replacing between 4 and 7 selections each month. That's usually a good sign. Typically we're going to close losing trades as quickly as we possibly can. We are going to have losers. Please understand this is not a 100% winning percentage. On average, our stock selections will reach that 20% target, about 67% of them. And about 30% of them will close as losing trades or no gain trades. So if you're holding on a stock 30 days, 60 days, 90 days, it holds that one bucket until we close the trade. And then once we close the trade, you would then refill that bucket with a new stock selection. Great question, though. Thank you. And Clark, again, thanks. Apologize for misunderstanding PDT. I thought that was Pacific Daylight Time. Sorry about that. Anyway, all right, that's all the time we have, folks. Enjoy the replay, and looking forward to working with you. Again, the link is in the chat box, in the admin notice, or in the pop-in box. I'm going to close everything down here in just a second. We'll get the replay out to everybody in just a little bit, and we'll also forward you on to the link here as we close down. I want to thank everyone for your time. Thanks for joining me again for the Millionaire Blueprint, and everyone here at Traders Reserve. My name is John Hutchinson, and I'm looking forward to helping you achieve your financial goals.